In this video, guys, we'll look at hedging with spread betting. Stay tuned. Hey traders, a warm welcome to you. Alright, so what is hedging and how can you use it with spread betting? So hedging is ultimately protecting your downside risk. Generally speaking, downside could be upside if you're short on an instrument, but let's keep it simple for now. Protecting your downside risk on something that you have exposure to. So in this example, it could be you've got a portfolio of shares, traditional shares in with your stockbroker, and you want to hedge some downside risk. So you think that the individual shares are going to fall down, or you think that the sector, or you think that the whole market is going to fall down as a whole, but you do not want to close the positions. So normally speaking, if you thought that everything was going to crumble, you close your positions and you go to flat. But hedging means that you keep your core positions open, your core exposure open, but you do something else supplementary to offset that risk. Example of hedging, if we go outside of this analogy for now, it would be with a farmer growing wheat. He has got that exposure to wheat. He can't change that. He's exposed to the price of wheat when he harvests and he goes to sell that wheat. So he's always going to have that exposure. If he didn't want that exposure, he wouldn't be a farmer. But to hedge against downside, he could lock in the price now by selling a futures contract at that point, which ultimately would mean that he would be able to give delivery of that wheat at that point in time to the person who's bought that futures contract at the point in time in the future the futures contract expired. But if we go back to this and we say, okay, right, we've got this exposure here, portfolio exposure, how do we hedge with a spread bet? Well, first things first, guys, I want to point out that potentially a spread bet may not be the most efficient way to do it considering tax liability, because spread bet is free of tax. If you've got a traditional share portfolio, you're going to be paying capital gains tax on that. So be aware that potentially if you lost on your hedge, but you made money on your thing, let's say your hedge was wrong, it was incorrect and the market kept rallying, you lost money on that, you wouldn't be able to offset that loss against the gain from here, even though you've technically made a gain. So that's something to be aware of. A CFD may be more tax efficient for you. I'm not a tax advisor, you need to look at your own personal circumstances, etc., 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 but just putting it out there. However, the fundamental concept remains the same, whether you're using a CFD, whether you're using a spread bet. So let's have a look. So we've got 10,000 shares of Tesco's in our portfolio, 5,000 shares of RBS, and 500 shares of Apple, for example. How would we hedge this? So individual hedging, we would isolate and strip out the actual stock or share itself. So let's say we felt that supermarkets were overdone and we thought they were going to have a struggling time over the next 6 months for whatever reason. Our 10,000 shares of Tesco's is equal to £10 per point. Very easy to work it out, guys. We're just moving the decimal point over. So £10 a point will give us exposure to Tesco's. Now, obviously, to get our hedging exposure, we need to take the opposite position. Now, because we're long Tesco's in our portfolio, we want to be short Tesco's with a spread bet. So you would sell £10 a point at the current price. Now, we don't have to hedge the whole position. We could hedge half of it. We could hedge £5 a point, £7 a point, £2 a point. But that would ultimately mean that we would gain money if Tesco's went lower on our spread bet, but we'd lose it on our longer term investment, which is what we're kind of trying to achieve ultimately, which is protecting ourselves from that. So imagine you've been sitting with Tesco's for kind of 5 years, you're looking for a 10-year investment on it for whatever reason, but you think it's going to struggle in the short term, then this is perfect. You'd short £10 a point, let's say it declines by 10-15%, you've made your money on your spread bet to offset the loss from your actual exposure to that, and you could then take that money out. And because it's a spread bet as well, you don't have to use the full positioned value. You can trade on leverage and on margin. So if the margin say 10% and Tesco's is trading at £2, say, then £10, 10,000 shares times £2, 20,000 pounds position. If you've got 10% on that, all you have to do is put up £2,000 to deposit to manage that trade. So very, very easy and simple to work out. Same with the RBS. If 5,000 shares, we could short £5 a point, and we could do both of these as well. If we wanted to hedge the risk on that, we could do everything. We could do the whole portfolio. Something to be aware of though, guys, if we're trading Apple, obviously Apple is in US dollars, so, and because the spread bet is in GBP, we would think it was 50p a point, 500 shares. We think, okay, 50p a point, but it's not gonna be quite that because we have to change that into a sterling amount. So it might be something, depending on what the exchange rate is, it might be something like £4 a point or £3.50 a point or something like that. So that's something to be aware of if you're hedging in sterling and USD. And also, obviously, you've got some currency risk there as well. Okay, that's hedging each individual share. What you could also do is you could hedge broadly. So let's say you've got a large portfolio or a portfolio with a different array of stocks in it, but you think that the market might well struggle for the next 6 months, but you don't want to take off these because you think they're going to be do okay longer term. You could hedge simply by shorting an index. You could short the NASDAQ if you wanted to perhaps you wanted to hedge some tech exposure you've got. You could short the FTSE 100. You could short any of the indexes or indices or sectors. You can sometimes strip out the sectors and short those. Say you've got a lot of supermarkets, you want to short that. So you can really express your shorter term opinion how you like, and it wouldn't necessarily have to affect your longer term holdings. Because obviously sometimes the tax implications, you don't want to sell it, you can't sell it, perhaps it's in some sort of tax-free wrapper, it's in an ISA or something, and maybe that's something to be aware of as well. If you have got it in an ISA and it's tax-free, then obviously spread betting just as good. You've got to work out your tax implications as well, and again, take some professional advice from that. I'm a trader, not an accountant. But you've got the functionality there, CFDs, spread bets. You've got the ability to hedge, take the opposite position in whatever you've got the exposure to limit that downside risk. And in fact, what you could do, final thing guys, if you wanted to be ultra aggressive and you were very, very certain on this, very, very certain, but you didn't want to take off, you could even take more. You could do £20 per point and try and be clever and try to make more on the downside, pocket that, so you ended up offsetting a £10 a point risk, but you made an extra on the other. Loads of opportunity, loads of ways of structuring it and hedging your risk, and also capitalizing from short-term views if you've got them. All right, guys, that is hedging with spread betting. Take care. See you next one. Bye-bye.